And hello everybody, it is Saturday afternoon, the 28th of December 2019, and welcome all you quant people, because if you're here watching this video, you have taken the step to become a quant trader. You live and die by statistics. So in today's video, we are going to be testing whether or not this is true. I recently did a scan and a survey and an analysis, you might say, of stocks after they cross below the 200 MA. When the close crosses below the 200 MA, what happens after that? And it indicated that 66.66666% of them would continue downward the next day. So that indicated to me that these could be good put trades. Now, first of all, I am not in any of these trades. I'm doing something here to find out more information about this type of trade. And like I say, it proved out at 66.66%. What I had was 18 results where the close had crossed below the 200 MA, and I think my standard was from 10 stocks from $10 to either $100 or to $200. I honestly can't remember which. But of those 18 stocks, 12 proved out good for a put situation, and the other 6 did not prove out. They were either bad or they were marginally good and not worth the effort. Alright, disclaimer time. Trading is risky. Risk no more than you can afford to lose. Do your own due diligence. Always use stop losses, not mental stops, but hard stops wired into the trade. That's if you're trading the stock. Now in an option, the stop loss situation gets a little eerie, and it's really difficult to find an appropriate stop loss. That's partly what this video is looking to satisfy, the need to know that kind of information. Where do you put a stop loss? Where do you put a take profit on these things? So you'll be able to follow along. I have included the list of all the stocks that are involved. Here is the legal disclaimer. Just pause the video, please, and read the words. Thank you. Okay, here we have our hypothetical trades. You'll notice that 3 of them are flagged in yellow. Those are the trades. Now, if you're trading the stock instead of the option contract, those numbers are going to be different. These numbers right here under Rand, where it says Rand, all those numbers in that column are just randomly generated numbers, and that's how I selected the 3 stocks. I had the computer generate random numbers, and then I sorted, and before I did the sort, I told myself I will take the top 3, and that's how this worked out. So once I did that, I had to determine how many contracts I would buy of each. And what I was trying to do here was equalize the dollar amount. So you've got a dollar weighted amount here so that they're all about equal. And that's important because if you have a 67% outcome, it means you're definitely going to lose on one of these. So you want it to be about equal to the other 2. And for those unfamiliar with option contracts, for example, this 15 cents, it looks like 15 cents, 65 cents, 43 cents. You actually have to multiply that times 100 to get the price of a single contract. Therefore, we come down here and our total cost is $394. Now, why a 3 basket? That's because if you look back 1 or 2 videos, and you can go to my website, orangequant.com, you will see where we were analyzing the optimal basket trade, and instead of a 2 basket or a 4 basket or a 5 basket, in other words 5 different stocks in these baskets, or 4, 3, 2, 1, whatever, that indicated that the optimal basket size was a 3 basket given a 67% outcome on our strategy. It's a very interesting, very instructive video. I urge you to go back and take a look. This is a one-day hold, and in theory we bought Friday. That's the Friday closing. Friday at the close, this was the cost of each contract, the ask for each contract, and we're holding through Monday. And it's a one-day, in other words, a one-day hold. Now some statistical trades are two-day holds, as you've seen in the past. This, for now, is a one-day hold because I didn't accumulate data for a two-day hold. And these down here, in white, black and white instead of black and yellow, those are the other stocks that resulted in this list. There are 9 altogether that came from the scan of Friday. Alright, so you can follow along and we'll see how this works out on Monday. You'll notice I haven't described a stop loss or take profit. That's part of what we want to learn from this hypothetical trade. Oh, and note, these contracts are expiring the 20th of January next year, 2020. You always want to give yourself some leg room there. You don't, well, if you're a high-risk person, you would buy one weekly that's expiring this coming week. But I'm not that kind of person, so I'm saying you want to be at least 2 weeks out. Or, yeah, you want to have expiration that's at least 2 weeks away. Okay, Dennis at orangequant.com signing off for now. We will come back with a results video later, I intend to.